You don't mince words, but you are definitely not wrong at all, right? And I think that's part of what we're seeing right now is there was a lot of financial engineering going on. And when you look out into the markets, I mean, how long have people been saying, hey, we've got over leveraged companies in the public markets, you've got a pension crisis, you kind of got all these things going on. And actually the people who were calling it out and kind of most aware of it were the people who aren't inside the system, right? They're not in that legacy world that is kind of blinded to all of this. And so you need those people to kind of check on reality sometimes.
So Pomp, I wanted to talk about this, going back to the stock to flow, if you don't mind. I want to talk about an idea that I think is really important. I think when we look at a quote that Satoshi came up with, let me see if I can find it really fast. I apologize for the delay here as I'm trying to find this on my phone. But, early on, Satoshi was talking about ideas around how you would value Bitcoin early on. And he was talking about a model that was very similar to mining physical commodities. And one of the things that he talked about was this exact model. I'm trying to find the quote here. And I got this just for people to know where I got this. I got this quote out of a book that's called The Book of Satoshi. And it's just a consolidated list of all these direct quotes from Satoshi. I really like to study direct quotes and not things that people are, well, I think he said something like this. I want to read exactly the verbiage that he came up with whenever he said it. I'm really struggling to find the quote here. Hold on one second. Oh, I can't find it on my phone. But let me just paraphrase it. And after I just said that I like to have the exact quote, let me paraphrase it. What he gets into is he talks about how when you have something that's really expensive, it incentivizes all those miners to go in there and capture that price. And then whenever the price is getting punished, they're not making money because their cost is below that. So they start shutting down. And he's basically describing the exact thing that we've all seen play out with the Bitcoin price through the last 10 years. And so what I find fascinating about all this is he was totally expecting the price of Bitcoin to follow and track very closely to the electrical cost. But what I think a lot of people don't realize is that as more miners come online and this difficulty adjustment keeps ratcheting up almost like a noose throughout that 4-year period, this 4-year period then throws in this shock, with the 4-year halving, it throws this shock into that stock to flow, ramps it up just like the model is showing. And then all the people that can't produce at that price, right? If I'm a miner and the stock to flow just increased at an exponential level to what I was just accustomed to, I'm now out of the market. I can't compete with the lowest cost producers that are maybe getting their energy for free because they're harnessing a waterfall or whatever the case might be. I drop out, and so does everybody else. But then what happens is you get that difficulty adjustment that automatically allows this to become competitive in the marketplace, and then the price stabilizes as it goes up there and tries to approach it. What I don't think people realize is that these early on, this price was heavily tied to the electrical costs. And as time marches on and you get more of these 4-year cycles, I believe that the price continues to be bound by that electrical price. But as you get more market participants and more people that pile onto it, the upside of that is not nearly as bound. And you can get in a point where it's almost like an orbital with like a spacecraft going around an orbit. If it just gets pushed a little bit outside that orbit, it can actually completely separate from the orbit and it goes off, and then it becomes global money. I think that's exactly what we're seeing playing out. And I kind of believe that this next 4-year halving cycle, combined with all the things that we're seeing globally with these debt markets just getting totally debased and totally manipulated, might be that final push that kind of kicks it out of the orbit that it's going in. And so as we look at the May halving that's coming up, and you're seeing the stock to flow models showing that it should be around 100,000, somewhere in that ballpark, right? And it's not gonna get there within the first. Well, it'll probably get up to that level within a year, this according to the model, and maybe even go higher. But I think as it pushes higher and you get all this global adoption, and then you have market caps that are in excess of trillions of dollars, I think you're going to have traditional financiers that are looking at this and saying, all right, clearly this is something that is not going away. This thing has been pronounced dead 150 times at this point, and it's clearly not dead. And I'm seeing the debasement that's happening. And I think that as you push this thing up and past $1 trillion, and you start getting this buy-in, and you get all these various vehicles that are allowing people to capture the underlying price through financial derivatives or whatever. And I don't necessarily know if I would call that GBTC a financial derivative, but I would vehicles like that are going to enable this thing to kind of bump out of that stock to flow price that's being held in there by this 2-week difficulty adjustment, combined with the 4-year halving. When you put those two together, I'll use a military reference. So, and there's a great movie scene that exemplifies what I'm talking about. So if you ever watch the start of Gladiator, and you have the longbows, right? The archers, the longbows, they shoot their longbows. And then you have all the cavalry that's flanking, going up the flank, around the backside. They don't see them because their heads are down, and the enemy is there trying to protect themselves from those longbow shots that are coming in. So they got their head down, they're hunkered down, they're trying to protect themselves. And as they're doing that, that cavalry of all the horsemen are going up around the side, around the flank where they can't see them. And then as soon as those longbows stop firing, they come in there on a fast attack, fast assault, and they go to battle, and they catch them by surprise on their side. What I think you have there, your longbows, and I'm using this military reference, people might hate it, but I love it. They're using the longbows. That's your 4-year halving cycle. That's the thing that comes at you when you just think it's so far out there that it's not correlated at all to a 2-week difficulty adjustment. But then after that longbow has been fired with that 4-year halving cycle, the 2-week difficulty adjustment that's your cavalry that's coming in, and it's just annihilating the living heck out of the speculators. And so those miners that are going in there and that are mining this, that are ratcheting up, that are trying to capture that price premium that occurs immediately after that 4-year halving cycle. All those speculators come in, they bid the price astronomically high, way above the stock to flow, and then the 2-week difficulty adjustment just keeps grinding it back down to where it needs to be. So why did Satoshi why did he design it this way? Okay, because I'm describing something that's saying that the price needs to be fixed at that level for a 4-year period before you go into another price bump. And then it needs to be fixed at that intrinsic value for another 4-year period. Why did he design it this way? My humble opinion of why he designed it this way is because he needed entrenchment. He needed people he needed this thing to not take off in 4 years, because he knows there would be too much drama around it, and that you wouldn't have the entrenchment into the existing financial rails in order to stop it. But if you can push this thing out over a decade, well, then you can get tons of volatility. People are going to write it off as being nothing more than a speculator's tool, right? That's what the crazy people go in and trade, because the volatility is over 60% annually. So only idiots are doing that. And so you'd have governments, you'd have very wealthy individuals that would just write it off as being nothing more than a speculator's game. But yet the thing keeps trucking along, and it keeps bumping its price up purely for the reason to capture and work its way in as a Trojan horse into the existing financial rails. That's my theory.
What would have to happen for you to think either one, the Bitcoin thesis is no longer valid, or two, something in your theory is inaccurate?
So I've been asked this before, and I think that the concern that I have is that early on, my concern was that it could be banned and that a government could step in and do something to it that could stop it. I don't necessarily have that concern anymore. I think that what we've seen globally, there are countries like Germany, there's other countries that are absolutely open, arms wide open to this thing. In fact, I would argue any country that's dealt with dollar dominance over the last 80 years, which is every country, has felt the pain of what that's like to not be a reserve currency. And they're looking at this as maybe being something, especially country. And I think this is why it's so popular in Germany, is because they remember it's in their deep cultural roots, the 1920 hyperinflation event with the mark, that they remember that culturally. They know how that played out and they don't ever want to see it again. So they look at fiscal spending a lot different than I think a lot of countries in the world. And so they're looking at this and saying, this makes a whole lot of sense. So as long as you have countries like that, it's never going to get shut down. And that's what a shutdown needs, is for everybody to agree that it needs to be banned. And I don't see that happening. So that was my original concern. I would say now it could be, the price could go down. You could see a lot of psychology, maybe push it lower. If you had miners that, I think this would be a concern. If you had miners that started really pulling their rigs offline and they were not in the business of swapping fiat for payments in BTC to stuff into their treasury on their balance sheet, I think that would be a concern. And we have pretty much seen the exact opposite of that. And I think I guess my personal opinion is you're always going to see the exact opposite of that for one reason, and it's the difficulty adjustment. Look at what we're going through right now. The price got hammered, right? And there are many miners that became unprofitable because of this derivative movement that we've just seen. But guess what? The incoming 2-week difficulty adjustment that's due here in a couple days, it's dropping 15%. To make it more accommodative for them to come back online and boost that price right back up to the intrinsic value. It's all by design. I mean, the game theory on this thing is nuts. And here I am trying to tell you how it could fail, and I'm still coming up with freaking reasons of why I don't think it's going to fail, because I've tried my darndest to come up with all the reasons of why this thing won't work. And all I can arrive at based on the game theory is that it is going to work.
Yeah. The only thing that you didn't say that I answer the question with is a self-induced bug. So from a developer standpoint, there's something that's introduced to the code base that could be like a self-inflicted wound. Obviously, given the development process, I think that's highly unlikely. But I'm with you in that there's just not very much externally that I think is a threat at this point. And so what you go to is kind of the self-inflicted stuff.
Well, I love that point. I think that's a great risk to highlight. And when we look back at the summer of 2017 with Jeff Garzik, right? Remember, Jeff did something really goofy there right at the last minute that could have really compromised a lot with just the trust and confidence in the protocol. I think that could play out. I don't know if that plays out, that the code can be adjusted. People can go back in there. They can adjust the code, right? The protocol, and those transactions, or the basically the stoppage that you would see throughout that period, are going back to make that adjustment. I think you'd lose a lot of trust for some people that are coin holders in the protocol. Now, would that trust go somewhere else? I don't necessarily know that it would long term. It might short term, but I think as all systems come back online, I think that you would have not everybody come back in, but I think you'd have a lot that would show back up, and they would stabilize the market. But I don't necessarily know if it would cause this loss in trust spiral that would take it down to zero. I don't think you're ever going to get that, because this difficulty adjustment is in the 4-year halving cycle is going to ensure that this eventually becomes global money.